Welcome back to Golden Rule Radio. We appreciate you tuning back in this week, a week of continued volatility and uncertainty in the U.S. markets. I know that you're tuning in because you want to focus on the precious metals and the markets that move those metals prices. And so without further ado, Miles, why don't you kick us off on the gold front?
Yeah, Tori, appreciate it. We're after the big drop here in the beginning of March, we're back up within about 1.5% of the previous high that we put in that first week of March on gold, just over 1,700. So gold has rebounded almost all of the previous fall, along with the equities market, and we'll touch on that too because the equities market is rebounding also, but nowhere near as much. So I think it is worth kind of backing the charts back out a little bit since we've moved on from the initial knee-jerk shock and just say, okay, we came into the 1,700 mark, we saw some resistance there, and that was expected, because it's a double zero. Anytime you hit those hundreds, you're going to see some emotional pricing at that level, people looking to take profits. And that was back during kind of the beginning of that step down as gold was coming down back in like 2012, 2013. So if we manage to push above and set a new high coming in over the next couple weeks, which I think is likely, I'd target somewhere around 1755 is going to be our next little resistance point, which isn't too much above where we're at now, somewhere between 1755 and 1795. But once we get above 1800, that's putting us easily back up into the 1900s and testing the all-time highs from 2011.
You sound very bullish for a currently deflationary market. I'm getting a lot of client questions about, well, one, why isn't gold higher? But two, you sound pretty bullish. I mean, optimistic on more of a climb than a pullback. How can that happen in a deflationary market?
Yeah, Tori, it's a good question because personally, I think it depends on how you define deflation. You and me being good old-fashioned Austrian economists, we would define deflation as diminishing the money supply, but that's really not how it works nowadays. Deflation has to do more with the demand for money than it does with the actual supply. And you know that because even though we're in a highly, again, by Austrian terms, inflationary economy right now, especially this past month as we're dumping literally trillions of dollars into the markets and into eventually your and my pocket, as they're sending relief checks out. But this has to do more with the demand for money than the supply because the US dollar is continuing to climb. And the reason being is people are seeking safe haven assets. So the dollar is still a safe haven. Now, you and I may have long-term opinions about the value of the dollar and what inflation over a long period of time actually does to our purchasing power. But on a day-to-day basis, the dollar is still the most liquid asset in the world. So deflation, from the modern understanding of it, has to do with the demand for liquidity and the demand for solvency, and both currency and gold provide that. So I think that's why you are seeing, even though the stock market has taken a big hit and not rebounded, gold is still up for the year, and we're closing in on those recent highs from earlier this month already.
Yeah, really good answer. I appreciate that. And, I think one of the misconceptions is that gold can only do well in times of inflation. Yes, it's an inflationary hedge, right? But from a deflationary standpoint, some of the greatest deflationary cycles in history have actually seen gold perform quite well because it too is a safe haven, right? And where are we seeing deflation right now? People are saying, well, wait, all this money printing, all this capital injection to stimulate the economy and a turnaround, or at least put a floor in here, is very inflationary. And that is true, but it's being countered by credit market contractions, right? You're seeing credit lines depleted and disappear. You're seeing trillions of dollars disappear out of the equities market. So that in the short term is going to offset, any inflationary measures they take. Unfortunately, with what the Federal Reserve has done, to the tune of $3 trillion, and what the federal government has done to the tune of $2.2 trillion to start, and it looks like another 250 in the short term here, 250 billion. That's money that doesn't get to be pulled back out. It doesn't disappear. So if you start to rebuild the monies in the equities markets and things really start to correct, and now you're starting to go back and flirt with the previous highs in the equities markets, all that money comes back into the system, plus the 5 to 6 trillion that's been pumped in. that's where you start to get the turn. And that's what you saw in 2009. And that is when gold and silver will be going up in concert with each other and likely silver outperforming. And so to transition into silver, why don't you take us there?
Yeah, I think it's the perfect transition to silver because this answers your deflation question immediately. Why is gold going up? Is currency going up? Why is silver not, or at least silver spot price? Because you and I both know that the physical metal is a whole different ball game right now. But silver coming in, silver's building a nice little compressing channel down. Remains bearish until we get above $25. I mean, the reality is gold has done some things that the white metals haven't, specifically silver hasn't, and silver's still in a bearish declining trend that we've been in since 2013. So until we start to see some of that movement up, I'm going to remain bearish on silver, except for the fact that gold has already moved, and that's exactly what happened last time. So it's really just the lag. So silver's waiting for the Main Street investor to get involved, and that just hasn't happened yet, at least not in the paper silver market, but we've certainly seen it in the physical silver market. So I'd love to
Absolutely.
see silver break out of this declining channel at least before I'm going to start screaming, okay, silver's going to play catch up. Certainly love to see it get above about $25.10, 25.20, which was kind of the last little high before we built this declining channel. And then I think we're off to the races there. So until that ends up happening and looking at the pricing ratios at 100 to 1 between silver and gold right now, still going to be a silver buyer, still going to encourage people to do so also.
Yeah, please hear us. That is where the value still lies. It doesn't mean you have to be bullish in the short term. We're looking very macro, right? We're looking at physical precious metals as something that you always hold in your portfolio. And so how do we compound ounces over time? We're not day trading the physical metals. You talked about the Main Street investor not being in silver from a futures market standpoint, and that's a really clear differentiator because the Main Street investor is absolutely in the silver market, in the physical market, right? So there's a ton of investing going on with ounces being acquired for home or for allocated physical ounces in depository or IRA. And the gold silver ratio, one of the primary motivators, is at 110 to 1. We had dropped down to 108 to 1 yesterday, coming off that 124 to 1. So silver actually has appeared to have put in a floor. I would assume that you would agree with, Miles, not to put words in your mouth. But interestingly, I mean, we're below the 50-day and 200-day moving averages in silver, and we're above both the 50-day and 200-day moving averages in gold, and pretty strongly. So the way the ratio works is at some point those two get closer to each other, either silver going up or gold going down. They could both go up and silver outperform. They could both drop and gold drop more than silver. So however that ratio ends up correcting, it still in all three scenarios favors being in at least a portion of your portfolio in silver.
Well, and I think that argument also gets laid out into the platinum market as well, right? I mean, platinum coming into like 20-year lows. Silver still has that little bit of poor man's gold concept behind it. Platinum's just an industrial metal. So platinum, it's obviously is going to take a huge decline like we saw. It's bounced up about 50%, of what the final fall was, but still has quite a ways to go. And platinum remains bearish over the last number of years as well, with needing to see prices 1,200 at least to start arguing we've followed the path of gold and we're breaking into arguably bullish territory. So I definitely think your question earlier about inflation versus deflation, and is this a deflationary situation, and why does gold go up during deflation? I think that you can see in the charts right now a pretty clear explanation about the purpose why people, big money investing, goes into gold during these types of crises. And you're seeing a lag in some of the more investment grade metals that people buy more for the sake of return than they do for the sake of preservation or protection.
Yeah, I appreciate you addressing another key question that I'm getting a lot from clients and people just calling in seeking information, and that is, the lag in platinum. We've got to go all the way back to 2008 to see platinum at its previous highs. And it has not come back and even flirted with those previous highs since. It absorbed the 2008 financial crisis. and the equities markets downturn and economic slowdown in 2009 and 10. It wasn't until 11 that you really started to have truth built in, or factual data showing that the economy was starting to turn again and the equities markets could be trusted. And still, platinum didn't go flirt with its previous highs, right? So the industrial aspect of platinum is absolutely front and center when you're looking at just the last 10 years. So is platinum an undervalued metal? Absolutely. Is it going to perform like gold and silver in the short term as they perform like monetary metals? Absolutely not. So you've got to be patient. Again, we're looking at the macro long-term hold, and that's why we cap your platinum position at between 10 and 20% of your total physical metals portfolio, because we are not trying to predict an economic recovery in the short term. We're not trying to predict platinum taking off and going to new highs. What we're trying to predict is that eventually its price relationship between gold, silver, and palladium narrows, and it ends up being a winning trade for you.
When we're seeing the exact same thing with palladium. Now, palladium started from a different spot than platinum did. Palladium started on at the end of a pretty massive run up, whereas platinum was starting more towards the bottom end of its cycle. But similar movement over the last month, right? You have this substantial decline. You have a rebound back up to about the 50% line. Platinum came up to 50. Palladium came up to the 786 fib. Very similar movement from an investment standpoint, just like silver. So all the white metals are doing the same thing, same similar percentage movements. It's really only gold and currency that are stepping out on their own right now because they provide that protection and that hedge.
Yeah, no, and that too is a really good point, because you have to understand that you're going to get a rebound anytime you have a really sharp decline, palladium obviously included. You tend to see, just like what you're seeing in the equities markets, you'll see a bottom, even if it's a temporary bottom. After an aggressive pullback, you get this little sort of V bounce oftentimes where it will go back up. You're talking about the 50% bounce, but you're seeing that in equities, and it doesn't matter which market sector. Eventually, things start to correct after overshooting, right? The industry calls it being oversold. And so it could be Marriott, it could be Boeing, it could be Chevron, representing three completely different market sectors in the equities. Go look at their charts. You get this overshoot, and then a little bit of a bounce up to a more realistic number once everybody has an opportunity to kind of determine a new value. Same thing happened in the metals, right? You may not have called the bottom. You may not have gotten in at $12 silver or $1,460 gold. You may not have gotten in at 580 platinum, but it doesn't matter. Again, we're looking at the long term. So some of that is going to change. What's not going to change is interest rates right now. The FOMC meeting minutes came out today, and basically no surprise there. The Fed's saying obviously they're going to keep interest rates at zero. There was no indication of going negative or further down at this point. But interesting quotes. I mean, again, it's not rocket science to know that, but that they're expecting a slow economy. They view the near-term U.S. economic outlook as having deteriorated sharply in recent weeks and as having become profoundly uncertain. Well, okay, that's, we could have interviewed somebody, one of those Main Street investors, and gotten that kind of a quote. But we don't know what's coming, right? And gold is oftentimes popular in times of uncertainty, the unknown, and the mind will take you to the worst case scenario, and that you can prepare or plan for, much like the hoarding of the toilet paper, right? So you'll see that initially in some investments as well. But what it's created, Miles, and I don't know if you want to talk to this, but what it's created is this huge widening in spreads in the physical market.
Right, and I think that tells the story of just the difference between a paper promise and the real thing, and it also tells you just how small the precious metals market actually is. I mean, the running joke is all the gold in the world would fit into a couple swimming pools. I mean, there's not a lot going around. You increase investor Main Street interest, even just a few percent. Now, granted, we also have to face the fact that refineries are shut down, mining companies are shut down, the mint's not putting out coins right now. So obviously there are supply side issues as well. So you get rid of the supply side and then increase the demand side just a couple percent, and it just wipes out the market pretty quickly. So we're definitely seeing pretty tight availability in product across the board in physical metals, and a whole lot of people still looking for it. So it's interesting how this plays out from time to time, and we've seen it before. It happened in 2015 when the stock market looked like it was going to fall. It happened back in 2008, 2009. Right after the stock market had fallen and interest had increased in metals. And that happened back in 04, 05 during the real estate bubble when I first came to work in the precious metals industry. So it's not unique. It's not something worth fearing. To any of our listeners out there who are calling around going, hey, do you have this? Do you have that? And hearing no's from various dealers they may work with. Don't think that's the new normal, but it may be normal for a bit here. So just be prepared. And supply and demand curve, when you put that much pressure one direction, you're going to see the prices move.
Yeah, and I think that spread that we talked about just as a gold or investment 101, that's the difference between the bid and the ask, meaning what you could buy something for versus what you could sell it back into the market for. And as that spread widens, that's also indicative of another term, and that is premium. So when you're asking an advisor what the premium is, or they're telling you about premium and you're wondering what that is the price you're going to pay over the spot price. And what we're seeing is premiums climb, which if the bid's not changing and the premium's climbing, that means you're widening the spread. And again, that goes with a high demand and a low supply type of environment. And also one where the bid hasn't started following the premium on the ask side yet, because there's not a lot of confidence in the market that the strength is going to continue, right? You're going to have to see new economic indicators and have new fear in the market in order for that to start to happen, I think. But those premiums are climbing. So even if we don't have product availability, we're having a premium issue. We can get junk silver all day long, which is a favorite product of ours, but you're going to pay a much higher premium in this market than you would in a normal market. That's not companies like us doing anything to price gouge. Nothing changes. It's literally the secondary market on the wholesale supply. And so keep in mind, premiums and spreads are unique here. And going back to your point on the two swimming pools, 30 ounces of gold, if you just own even a kilo bar worth of gold, you're in the top 1% in the world of gold holders. And so let that kind of sink in terms of the total availability. All it takes is 30 ounces in a currency collapse, and you're suddenly in the top 1% of net worth in the world. So, but we did hear good news that the Royal Canadian Mint is going to start ramping back up production. They've had staffing restrictions due to COVID-19, and you've had refiners that were shut down that now are reopening. So I think we're going to see an easing of some of those supply issues. The Royal Canadian Mint, we've had no availability essentially on gold, silver, or platinum maple leaves, and that should start to open up again, and we'll just see what the premiums are doing. So that's going to do it for this week's Golden Rule Radio. We appreciate you tuning back in. If you like what you heard, please follow us on Twitter at ICA Gold. You can certainly always go to our website at McIlvaneyICA.com or Facebook, McIlvaney Financial. And as always, you can hit the subscribe button below, and you can call us and speak with an advisor about your individual portfolio at 1-800-525-9556. Thanks for listening, and have a healthy and safe week.